A new AI automation tool from Anthropic sparks a rout in software stocks in the U.S., wiping out more than $300 billion. It's now playing out in Asia, and India is on watch, where some of Asia's biggest IT services firms are listed, with ADRs of Infosys and Wipro plunging in New York. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks in the red as the tech rout in the U.S. sparks a rapid shift into more economically sensitive sectors. Pimco MD and economist Tiffany Wilding joins us with her view on Trump's nominee for the next Fed chair and what it means for rates and the economy.
I'm the minister, not him. I understand fiscal policy very, very, very well. I learned from the best from everybody in the world about fiscal policy. In the future, I don't want to surpass the 3% level because people like you, media, will crucify me and tell everybody that I don't know my job.
Indonesian Finance Minister Purbaya Yudi Sadewa hits back at Citi and the media with a spirited defense of his economic record. More from my conversation with him ahead. An Indian fintech firm, MobiKwik, turned profitable last quarter. We explore the drivers behind the turnaround with co-founder and CFO Upasana Taku. And Hong Kong's property market shows signs of life. We get the outlook with JLL's APAC head of investor intelligence. Asian markets showing signs of weakness today following a stock rotation in the U.S. Declines in software makers weighed on Wall Street as traders sold out of the sector over worries about how AI may impact the industry. For more, let's bring in our Asia Tech correspondent, Annabelle Jewelers. Belle, why did we see such extreme selling pressure?
Yeah, it certainly was a very broad-based sell-off overnight. Sparked, of course, initially in these software stocks that relate to the legal sector in particular. But I think we just need to sort of walk it back a bit and talk about what we've really been seeing for software stocks for a number of months now, which is, again, a lot of downward pressure and concerns about the impact of AI to that traditional business model. So this year in particular, we've had a very weak beginning, and software in particular, software stocks are really being affected by releases that we're seeing from Anthropic. Now, Anthropic's AI tools have been particularly successful with enterprise customers, and just a couple of weeks ago we were discussing this very same topic because it was the release or the early release of an AI agent called Claude Cowork, and now Claude Cowork's capabilities have been expanded to the legal sector, which is why you saw that sustained pressure overnight. But you can see here this chart, I mean, you're looking since the beginning of 2025, and you can see that the trajectory has been downward, even though it has accelerated at the start of 2026. The concern here is that when you have these AI tools, and Claude Cowork was built mostly using AI agents, it really threatens that software as a service model that's been a one that's really stood in place for a number of years now, continuing or recurring revenue streams for these businesses. That's certainly at risk, and it's why investors are leaving this group as a cohort.
Belle, what about the read across to Asia? Will the impact be as bad?
Yeah, definitely in the session so far today, we are seeing some names that are coming under quite significant pressure, particularly in Australia. You're also seeing some laggards in Japan as well. It'll be interesting to see how some of the key software names in India open in about 45 minutes from now. But overall, actually, the analysts we're talking to are a little bit more positive on the outlook for Asia, and there's a couple of different reasons for that. You've got the likes of IG International, for instance, that says that actually Asian tech firms are further up the value stream when it comes to AI, so a little bit more insulated perhaps. Yes, you might see some selling pressure in names like Tencent or Baidu or Alibaba, but they're actually doing much better at AI monetization. Allspring Global Investments, you can see here, again, they're saying that the Asian tech sector is better positioned with that heavier weighting, of course, toward hardware, particularly in Taiwan and Korea. But Wilson Asset Management, again, they're saying that sell-off in Asia should be less intense. But, of course, it is today very much a weakness. You can see the overall IT sector down 1.3% right now.
Yeah, getting hit, but not that bad. Belle, thanks. Our Asia Tech correspondent Annabelle Drew is there, coming to us from Hong Kong. Now, markets are also tracking the latest personnel developments at the Federal Reserve. Traders are betting on a dovish policy shift this year after President Trump nominated Kevin Warsh as the next chair amid his campaign to pressure Jerome Powell for rate cuts. Options data shows swaps traders see the next 25 basis point cut coming in July and potentially 2 by September. Meanwhile, current Fed Governor Stephen Miron has stepped down from his post leading the White House Council of Economic Advisers. Miron has been serving at the Fed since he was nominated by Trump in September, with his dual tasks drawing criticism for undermining the Fed's credibility. Let's get insights on the Fed with our next guest, who says she is confident in the outlook for its independence. Tiffany Walding is an economist at Pimco and has also worked as a Treasury market policy analyst for the New York Fed. Tiffany, good to have you with us. I mean, we've seen how President Trump has put a lot of pressure on Jerome Powell to keep cutting rates. And, of course, he has resisted. I can't imagine Warsh is going to be put in a position to, I guess, push back on the president.
Yeah, I mean, I think it's going to be tricky for whoever the Fed chair is going to be. We think Warsh will be able to manage it, though. And I would say that the market readout that he is one of the more orthodox choices here, we think is the right readout. There's a couple things to note about Warsh. So he likes to follow policy rules. So John Taylor, economist at Stanford, devised normative Taylor rules for the Fed. We think he will emphasize, a Warsh-led Fed will emphasize these tools and rules more. We think he'll try to talk less. He'll have less emphasis on the forecasts. And then on the balance sheet, we think he'll try to reduce it. So I think all of these things are within the realm of reasonable. And I think it definitely, he clips some of the tail risk in terms of these more extreme outcomes with big reduction in interest rates without the economy actually needing it.
All good until Trump puts tremendous pressure on him, and we have to see how he responds. I mean, in terms of independence, just how much independence do you think he will exercise, he will have, in fact, under this Trump administration? Yeah, well, I mean, we like to think that we're maybe past the peak in terms of us talking about Fed independence. We're a little bit past peak Trump in that regard, we would argue. And the reason for that is that Trump, like every other president, is actually facing some constraints. The first constraint that he's facing is just the Senate confirmation hearing. And senators have been very loud and clear with the administration that they don't want an unorthodox candidate. And that's why Kevin Hassett, the other Kevin that was kind of a top contender for this, has not been able to get the nomination. He would not have been able to get past the Senate. But the other constraint that they're facing is the Supreme Court. And the Supreme Court is about to rule on the Lisa Cook case, likely making it more difficult for the administration to fire folks that are sitting at the Fed. So once Kevin Warsh, that is in the position, we think the structure around the Federal Reserve is such that, that independent structure is going to be maintained and strengthened, giving him a little bit of cushion. I'm just wondering how this might play out, because he's also talked about how they need to work closely with the Treasury. I mean, that begs the question, what happens to independence? I had a conversation with the finance minister of Indonesia just yesterday talking about synchronicity between the central bank and the finance ministry. I mean, how do you have independence when you are working closely, when you're so synchronized? Yeah, I think that's a really good question. And there's definitely a fine line there. Now, keep in mind, I would argue that synchronicity is nothing new throughout the 2008 financial crisis and beyond. But even the response to the pandemic, there's a lot of synchronicity between the Federal Reserve and
the Treasury in terms of the crisis response. I think what Kevin Warsh is trying to do is he's actually trying to, he's called it a Fed Treasury Accord, and he wants to set, what I call the rules of engagement. So how should the Federal Reserve behave? This is how we are going to behave. And remember, any policy that he sets is going to also have to be agreed on by 12 other folks on the FOMC. So the Fed sets its policy, and then they coordinate with Treasury in the sense, or they communicate with Treasury that, so then Treasury can change its issuance policy, for example, or Treasury can change its own policies, in order to, manage the debt of the United States government as it sees fit.
So 2 cuts, maybe 3?
Yeah, that's where we are for this year. Yeah, and we think inflation's going to come down. So as I mentioned, these rules that we think the Fed will have adherence to, they would suggest that as inflation comes down, which I think there's a good reason to believe it will.
Why?
Some more cuts.
It's still far away from 2%.
Yeah, and it's been stickier this year. But if you look under the hood of that, the stickiness in U.S. inflation has really come as you've had goods inflation that's accelerated, and that's related to tariffs. But other than that, service inflation is continuing to moderate. The good news is we think the tariff-related adjustment has largely run its course, and you're also seeing productivity that's been pretty strong in the U.S. this year, and that should also put some downward pressure on costs that companies face, and allow that inflation to moderate as well.
So in terms of how much work the Fed has to do for inflation, maybe not that much more, but how about the labor market?
Yeah, it does look like the labor market is stabilizing here, and I would say that fiscal policy, is actually, in terms of the labor market, kind of working in the Fed's favor, if you will. So we will get pretty big tax cuts. They were passed in the One Big Beautiful Bill Act. We kind of jokingly call it OB3, but they were passed last year, and we estimate a percentage point of GDP in additional tax cuts the households will receive. So that will give the economy a little bit more stability, broaden growth out next year, or this year, and that should help stabilize the labor markets even further, we think.
Warsh has been really critical about the balance sheet, and some say that for him to pull back on that, he'll be compensated by lower rates. Talk to us about, how you think about how he might go about doing it.
Yeah, so there's always this question of what they want to do versus what they can do. And on the balance sheet, there's constraints, right? And the constraints are post-GFC Dodd-Frank regulations basically required banks to hold highly liquid reserves. The Federal Reserve supplies the market with reserves. So you will have to have some bank regulation reforms over time to really shrink the balance sheet and reduce banks' willingness to hold reserves. We think over time they can get that done. That's not going to happen overnight. He's not going to be able to reduce the balance sheet overnight. What he can do is he can try to reduce the weighted average maturity of securities the Fed holds, and we think there is a better chance that he do that. So hold T-bills instead of coupons or bonds, and we definitely think they want to try to get rid of the MBS securities over time on their portfolio. And that's not that controversial. Before the great financial crisis, the Fed only held T-bills, so it's really returning the balance sheet to a more normal state.
When you take a look at monetary policy as a whole, you see a lot of divergence. We saw the RBA raise rates, the first one to do that in 2026. Yeah. I'm just wondering what the opportunities are for you. How are you looking at the opportunities given that divergence in monetary policy in the world?
Yeah, exactly. Well, when we think about where we want to invest in bonds, we like to stick to high-quality bonds, but we want to look at markets where you've had a central bank that's maybe a little bit behind, maybe inflation in that market was a little bit behind to come down. You have tight fiscal policy, so maybe Australia, fiscal policy is a little bit easier, but you have tight fiscal policy which allows the central bank to cut interest rates more quickly. And when we look around the world, really where we see the opportunities along those lines is the UK market with the Bank of England, which we think will cut faster than what's priced into markets. But we also like EM securities. So if you look at places like Brazil or Mexico, EM central banks, even though their inflation came down before DM, their central banks kept interest rates high. So those are the areas that we really like to focus on, in terms of our thinking about where it's attractive to invest, globally in bonds.
How about EMs in Asia? Anything looking attractive?
Well, some of the Asian central banks have also been able to normalize, more quickly. If I look at some place like India, we think the outlook for the RBI actually now is probably going to be more towards a hold. You saw tariffs; they negotiated, some agreement with the Trump administration. Tariffs are actually coming down. The Indian government has implemented some labor reforms. They're getting a pickup in investment, and they even had a little bit of fiscal easing to kind of pad their economy. So I think the distribution of risks for economies like that are actually going more towards hikes as well. So kind of an interesting dichotomy here to be a bond investor.
What's also interesting is Japan. We're still waiting for the hike to come, but it is stuck between a rock and a hard place.
Yeah. Well, Japan. I think Japan is a tricky one because you had decades of low policy rates, 0% inflation and subpar growth, and now the pandemic basically shocked Japan into this higher inflationary environment. And the issue is that the government, set its fiscal policy to this low rate environment. They could fund deficits effectively forever before, and now that you have higher interest rates, funding those deficits is more expensive. And so the government, needs to react to that. But the Bank of Japan also needs to be careful because if they hike interest rates too much, then that can cause more concerns over fiscal sustainability in Japan. So they have to kind of slowly ease into this new environment, as they go. And that's why we think they're kind of moving slowly here, but they are moving, and we think they will get here.
All huge issues, but I want you to bring back to the top story of the day for us, which is, the capitulation, if you wish, of software stocks on the back of, AI. I'm just wondering, how are you weighing on the issue? I mean,
no, we think AI, it's a lot of disruption and it creates a lot of winners and losers. And I think the interesting thing about AI is that, although growth has been very resilient, both in the U.S. and globally, we think a lot of that is because AI has accelerated. As you've had the U.S. with these various policy pivots, with increasing tariffs, they've basically offset the growth headwinds by accelerating AI. Now, AI itself is creating these disruptions. And so you have winners and losers. And so it really, really matters what credit and what investment selections you're having. Because you have this great growth cycle that's happening, but under the surface, you can still get, a bad credit cycle. You can get increased defaults because you're getting this disruption. So for our perspective, it just increases the argument for active management within the bond market because you really have to focus on who's behind and who's ahead in the AI race.
Do you see further capitulation for these software companies, in a sense, as, we see advancement in AI?
Yeah. I mean, we think a lot of industries are going to get disrupted. It's not just software. We think the way retailers do business, for example, is going to be disrupted. And I think when it's a little bit, when you're thinking about risk now, within sectors, it's not only about what sectors are going to be the winners and losers, but what companies within those sectors. And it's really the companies that are investing in AI, they're going to be the ones we think that are going to come out ahead because they're going to be able to expand their opportunity set and they're going to get more labor efficiency gains within their companies. And if you're not investing at this point, you're behind.
How are you weighing on the bubble issue? I mean, some say there is no way you're going to get that ROI that you're looking for given the amount of capex that we're seeing right now.
Yeah. I mean, it does seem like when we look at valuations are they're elevated on traditional metrics, right? I think it's really difficult, of course, to always call the top. So, and I think there is more room to run. If we just look at AI implementation, it has increased. It increased pretty dramatically in 2025, but AI implementation overall is still pretty low. And we look across the globe. We think there's actually a lot of room for more implementation here. So eventually, you could go through a boom and bust cycle when these new general purpose technologies come up. Historically, they've coincided with boom and bust cycles. So I think you have to be careful. Active management here is important. But for right now, we think there's some room to run. But it probably will be a more show me equity market, right? Like show me the money, show me how you're monetizing all of this AI.
It's all about data. It's all about returns. I'm just wondering, before we let you go, what's the big theme that we should be focusing on and how best to play that?
I mean, like I said, it's a winners and losers global economy. You have these various transitions that are happening, this digital transformation, but that's also creating, more geopolitical tension, right? You need energy to fund all of these, data centers and things like that. We have, of course, the Trump administration, which is changing the way the United States interacts with global institutions. So all of this is again, just creating a lot of volatility, and just a lot of dispersion, which is great for investors and active managers.
Tiffany, great having you with us. Do come back. Tiffany Wilding, MD and economist at Pimco. Still ahead this hour, turning a warning on its head. Indonesia's finance minister says MSCI's downgrade threat may actually be good news for the country's stock market. Minister Purbaya Yudi Sadewa explains why. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Indonesia's stock benchmark is showing signs of steadying as the market looks to recover from a massive sell-off sparked by MSCI warnings over its investability. Now, the JCI has just turned into the negative, currently down about 0.1%. We're seeing the Indonesian rupiah trading at 16,771. It is currently down about 0.1% versus the USD. And when it comes to demand for Indonesian bonds, we're seeing the lowest demand in about a year. And Indonesia's finance minister says he's not concerned for now about the possibility of an MSCI downgrade to frontier market status. Speaking to us at the Business Forum in Jakarta, Purbaya Yudi Sadewa also explained why he thinks the index provider's warning is actually a good thing.
As I told you, the intransparency in the market was quite big. I've told myself to the stock market management at that several months ago to clarify the market from this cooking practice of manipulating prices of shares, but they didn't do anything. So to me, MSCI warning is a good thing because I can write them to clear the market practice toward the better.
Are you concerned about a possible downgrade?
No, because it's improving the condition. Unless we ignore the MSCI warning until May, then we have to be concerned. But I think the government and every market regulators have taken a proper approach to ensure that before May this year, we will satisfy what the MSCI wanted. So you should be okay. You should be fine. And I think in my country should be okay. We will follow adhere to the global best practices.
You're expressing confidence, but there is a real risk of being downgraded by the MSCI. Are you prepared for that? What measures are in place that could possibly mitigate the impact of a downgrade?
No, we will satisfy all of the MSCI's, all of things that MSCI wanted, including basic transparency. For me, as a Minister of Finance, I'm not involved in too much with what's happening in the boards, but I focus to ensure that the economy moving in the right direction. We make sure that our government spend enough money in the first quarter, second quarter in a timely manner, and we ensure also that there's enough liquidity in the market, and we are making sure that we are improving our business climate. We have this special task force of the bottlenecking, where every businessman can report to us, and on a weekly basis we have a meeting, a proceeding to ensure that the bottleneck that they are facing is removed properly. I think 1 year from now, we will have a different and much better business climate condition. That's enough to create a better and faster economic growth. Eventually, it will be represented on the increase on prices of shares in our capital market.
Coming up, Asia's private markets are entering 2026 with what many investors call cautious optimism. HarbourVest Partners will tell us why they share that view. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and here's a look across Asian markets as mainland China heads to lunch and Japan comes back online. Major stock benchmarks in the region tracking a tech-led sell-off from the U.S. Of course, there's a sense out there that perhaps AI will pretty much send those software companies to the bottom of the barrel, seeing losses in the likes of the Hang Seng currently down by 0.7%. The Nikkei 225 also in negative territory, down 0.6%. Now, software makers' shares are in focus, as we said, as fears grow over the disruption of their businesses, as the use of AI gains traction. We'll be watching shares of Indian IT firms, in particular the likes of Infosys, Wipro, once trading starts in a few minutes. The ADRs, by the way, fell sharply overnight. And some call it the Syspocalypse. Others are saying it's a software loan Agadan, as shares of Wall Street's largest alternative investment firms plunged on Tuesday, driven pretty much by fears that AI-driven disruptions would cause steep losses on their books. Let's get perspective from Hemal Mirani, Managing Director and Head of APAC at HarbourVest Partners, a global private markets investment firm overseeing more than $146 billion in assets. There's reason to be concerned, right? I mean, AI is progressing so rapidly, software companies may just be irrelevant.
You know, we've been investing in venture cycles for over 40 years, and these are moments that we live for, right? Disruption, innovation, new ideas that come to the forefront in doing that. But these take time to adapt, right? And the software firms are also going to have their strategies in terms of how to use AI in terms of what they do. So there will be winners, there will be losers, but I think this is an exciting moment in the industry for us to all have access. But this is also a reason that we do tell all of our investors diversification is what you have to think about. You want software, you also want AI in your portfolio. Think carefully about how much of exposure you want to both of these.
So we're not necessarily looking at capitulation of software companies,
that
correct? Because they will pivot, they will invest in AI themselves, and they will remain relevant. So perhaps the sellers that we're seeing right now is a buying opportunity.
It could be. And we've also got to remember that all of us that are using AI, we're adapting as well. There are places where it is very helpful, and there are places where we're not quite sure about the responses that we're getting. When you look at business use, we've also got to think about regulation. You've also got to think about compliance in terms of how you are adopting and adapting to all of these new technologies that come in. So I think there's going to be buying opportunity, and I think there's also going to be opportunity to invest more in AI as new models come out and new uses of AI come out.
We talk about opportunities. It is about valuations. How are you looking at that?
So we invest across different sectors in terms of looking at the early stage in terms of doing that, where many of these companies are sometimes an idea in terms of what we do. So backing managers who are very good at finding entrepreneurs who will build this. We're also in the growth stage, and that's probably where valuations have the most impact in terms of what you see as growth potential. And then we invest in the later stage as well in terms of where business models are a lot more established and they are more positive in terms of doing that. So we build a portfolio that allows us access to all three of these, recognizing that there is opportunity in all of them.
What are the biggest changes you've seen in the private market so far? I mean, as we kick off 2026, are there differentiating factors given the current environment?
So, I spend most of my time in Asia Pacific, right? So let me give you an example of sort of the changes that we're seeing and what we remain excited about. I'd say Japan's a big opportunity. I've been talking about Japan as an opportunity for 20 years, but it feels like the moment has come in terms of a buyout market that is developing. A lot of this is coming because you've got corporate governance changes that are taking place. Yeah, and you've also got over 2 million small to medium-sized enterprises where owners are over 70 years old. And for the first time, they're thinking about succession. Private equity can be a great solution in terms of doing that. Then you've got the publics to privates that are taking place. You're seeing new manager formation, which I have not seen in a long time. So your ability to go and choose and pick managers in where you want to be investing is a very new opportunity that we're very excited about. The Indian markets have started showing some great distributions back. You've seen a lot of the listings that are taking place, and finally distributions are coming back. And that tends to build a lot of confidence for investors in terms of wanting to deploy more in those markets. And I will say I was very happy to see with the Hong Kong IPO markets taking off the way that they did towards the end of last year that there is a little bit of optimism that is coming out on China and China venture as well.
Let's break them down a little bit. Japan, any concerns about the political uncertainty? People talk about a possible Liz Truss moment, where because the government has yet to prove that it is able to, I guess, fund the projects and the spending that it has in mind. I'm just wondering, might that influence and shape the way investors look at Japan and the deals available?
So I'd say let's separate that question into two. From an opportunity perspective in Japan, I think there is a lot of reform, and the catalyst has been put into motion for more deals to get done. Interest rates may vary, but you're starting from a very low base to be able to move up, and there is room to move up. Opportunity is large, so I don't worry from an opportunity perspective. We also look at managers to see how they're going to create value in these companies once they buy them. So there are a lot of tools that are available in terms of doing that. Where I sit and have a few worries is one is interest rates and how far do they go. The other one is currency. We've seen depreciation in the currency and you've seen volatility over there. So I am a US dollar investor. So at the end of the day, when I'm judging where I have made my investments, it is a US dollar rate of return that I'm looking for. So the currency is something that we do pay attention to. And the way, again, we talk to investors about this is building a portfolio that's diversified. You've got Australian dollar, you've got Japanese yen, you've got US dollar, different currencies in there so that there is a bit of a natural hedge that takes place in the portfolio.
But a big question about where the US dollar goes from here as well. So therein lies the uncertainty.
Absolutely.
As well. You talked about India. What's exciting about it? And where are the deals right now?
So at the high level, big market. Big consumer market, 1.4 billion people. You are seeing a venture capital industry that has grown. And it's not just grown. With the IPO market, you have seen delivery of returns that have come back. I think we've all been waiting for a long period of time for that moment. So I think that has built confidence in terms of companies that can be built and scale that can be achieved. You've also got some of the same challenges on family businesses, where maybe the second or the third generation doesn't want to be running a business that their grandparents may have started, and are looking to do more investments or startups. So you are seeing buyouts also taking place in India, and that, I think, is another new opportunity that we're seeing in India.
How big are these deals? How excited are you that we might see those big deals coming through in India?
So 4 big deals to come through, right? You need the small ones to have been very successful, and that's how confidence grows. And I think over the last 3 to 5 years, we have seen it. We're seeing private equity managers write investment checks of, $150 to $300 million in terms of deals that they're doing. And I think that will continue to grow in that market.
And of course, the biggest uncertainty for India has been actually the lack of a trade deal between the US and India. That has finally come through. And we've had the budget recently as well. Do you think that's enough to perhaps give that added boost, in terms of interest in the Indian market?
So I'd say yes. And, also a lot of what private equity is investing in is domestic consumption, right? So while you want everything on a global stage to be on the positive side, you look at investments that have been made in financial services. There is growth in India at the GDP level, and you're seeing credit growth that is taking place in India. Private equity is investing in financial services. It's investing in consumption, because a lot of this is around that domestic consumption story in India.
And Korea, that's another exciting market?
That's correct, especially when you're seeing with regard to a lot of the technology and the deals that are getting done over there. Now, whether that creates enough for private equity or that remains with the conglomerates, because you have seen a lot of investment come from there, but I think there will be partnerships that will get formed where there will be opportunities to continue investing over there.
We've talked about how it is a pretty uncertain environment right now. We talk about slowing growth. We talk about tariffs have yet to play out in a way fully. What are the risks to all the projections that you're making?
So there are always risks, right? When you invest, you can't avoid that. And again, I keep coming back to diversification, because you need to build a portfolio that's got the resilience to manage through these risks. Windows of liquidity open and close very quickly, particularly in Asia. And so one of the things that I'm always spending time with my managers is, do they have a prepared mindset? Do they have their companies ready for an exit plan so that when these windows open, there is an opportunity to go and do something about it? And that is the constant drum of conversations that we continue to have with them. Currency definitely continues to be another one in terms of what keeps me up at night every now and then to look at how we're going to deliver the returns that we have talked to with investors.
You're excited about the opportunities here. Is capital as excited as you? Are you seeing that rotation from the US to Asia or from the other markets gravitating to Asia?
So I will say, I don't know whether it is leaving the US as much as there is the incremental investments that everyone is looking to make. They're looking at Asia and the growth opportunities over here. I think there was a moment in time when it had moved away and it was a lot more in the US, but today you are seeing investors beginning to have conversations around where else they can be investing in Asia, what are the kind of opportunities that they have, and we're even getting questions on China and how to be investing in that market.
Pamela, I just want to draw your attention to what we're seeing in the markets right now, pre-market in India, because you're excited about the market. We're seeing actually those software companies getting hit in a big way. In fact, Infosys is dropping 5% in pre-market trading. TCS is dropping about 3%. So we're seeing a massive reaction from that expectation that software companies will be decimated by AI, progress. I'm just wondering, any reaction from that? Is it a surprise?
So maybe the reaction is not a surprise because that's what markets do, right? And we're very fortunate to be in private markets where I do not have to react to everything that is going on in the public markets and really be spending the time to think through that portfolio construction and what else I want to be investing in. So cycles don't move that quickly. New ideas come very quickly, but in terms of something turning obsolete doesn't happen that quickly. You also
so this could be a knee-jerk reaction.
It could be a knee-jerk reaction.
Right.
And you will start hearing from the software companies in terms of what they have put in plans to be able to deal with AI, the advent of AI, and how they're using AI to create more efficiencies within their own businesses and continue to grow.
You talk about how you do not have to respond to the daily headlines. In the next 12, 24 months, what are you most excited about? Where should capital be deployed?
As I mentioned earlier, in Asia, I continue to think Japan is a place. But, also when we look at sectors in terms of where we want to continue to deploy, in Japan, we're more generalists in terms of doing this because we are seeing an unwinding on the corporate governance side. In India, the consumption story is still very strong. Consumption and financial services will continue to be strong in terms of what we do. Korea will be around technology in what we do.
Australia?
Because and Australia, I was just going to come to Australia in terms of the mid-market where there are a lot of growth opportunities. And you're seeing a lot of companies that are built for global right from the beginning. Australia is a small market in some ways. And so the companies that get built for the globe, and much larger companies in terms of doing that.
Great perspective, great tips. Hemal, thank you. Hemal Mirani, MD and Head of APAC at HarbourVest. Now, Bloomberg has learned Singapore's two largest state-owned investors are making major changes to the way they work with hedge funds. Sources say GIC is shaping up its external managers department, replacing its veteran head and hiring more staff. And Temasek has been reaching out to a wider pool of hedge funds for potential investments. For more details, let's bring in Asia investing reporter David Rumley. David, is it fair to say that this was kind of like in the making? We kind of saw this coming.
Yeah, I would say so, especially in the case of GIC. Betty Tay, she's been in the role for quite a long time. This is a genuine, honest retirement from what I understand. So I wouldn't say that it's a strategic move to replace her due to performance or anything else like that. And coincidentally, in the case of Temasek, they have that overall reshuffle we've previously reported on kicking in from April 1. So increasing its allocation to hedge funds, external managers and hedge funds is definitely a key priority.
So what can be expected from these changes?
Well, I think you're going to see more engagement. Again, Temasek and GIC won't be working hand in hand on this, but you will see Singapore as a whole being a source for more money for hedge funds around the world. Temasek already has about 10 multi-strats and macros on the books, including Citadel, obviously founded by Ken Griffin. And we'll probably see more relationships open up. According to my sources, they've been reaching out to various hedge funds, trying to see just the usual due diligence that an institutional investor would make. And I think this comes on the back of pretty strong performance by hedge funds, both globally and in Asia in 2025.
earlier you talked about how this is not quite related to their own performance. Do they expect their own performance to improve given the new strategy then?
Well, it's hard to say, right? I think that, one could always say competition breeds excellence. In the case of Temasek, they have been somewhat happy with some of their performance in some of the years over the last 5 to 10, but certainly there have been some years that it's really been below what hedge funds have delivered and also below what even the S&P 500 has delivered. So always room for improvement at all these firms.
David, thank you. David Rumley, Asia investing reporter there for us. Let's do a check on Indian markets as they kick off their trading day. We saw how pre-market we've seen Indian software companies under a lot of pressure, the likes of Wipro and TCS under pressure on the back of expectations that software companies will be decimated given the progress in AI, a new AI automation tool from Anthropic, sparking a rout in stocks pretty much across the software, financial services and asset management sectors. The Selloff started, of course, in the U.S. market, as traders pointed to a release on the Anthropic website as the reason behind steep declines in shares of certain companies. We're seeing pretty much a red across the board. Tata Consultancy down more than 5%. Also, Infosys, HCL, Wipro under the same pressure. HCL Technologies down about 6%. And in terms of the Indian rupee, trading down by 0.3% versus the USD. Still to come, a one-time gain has pushed Adani Enterprises to a record quarterly profit, but the underlying picture tells a different story. More details just ahead. This is Bloomberg. Welcome back. You're watching Inside. India's been trading for about 5 minutes now, and we're seeing outsized moves in Indian software companies, the likes of TCS and Infosys. In fact, Infosys dropping as much as 6%. TCS dropping as much as 6% as well. Take a look where they are right now, recovering just a tad from the open. That's on the back of Anthropic, the new AI automation tool for Anthropic, sparking a rout in stocks across the software, deeming those software companies irrelevant, they say, as AI progresses. That fear playing out in the Indian markets, in particular, TCS currently down by almost 6% right now. Wipro currently down by 4%. We're also keeping an eye on Adani Enterprises after the flagship firm controlled by Gautam Adani posted its highest quarterly profit on record. But the strong results were purely due to a one-time gain from its exit out of a joint venture, masking continued pain in its coal trading unit. Let's dig into the results with our conglomerates reporter, PR Sanjay in Mumbai. PR Sanjay, talk to us about the numbers. Break it down for us.
Thank you so much. As you rightly said, there's this flagship of Adani Group, Adani Enterprises Limited, was held by one-time gain when they decided to divest their agri business, which was like a smart decision. What investors all hail about those kind of decision, which is now which helped this quarter, this reporting quarter, to boost or to record the highest ever profit for Adani Enterprises Limited. But at the same time, investors are very happy about the kind of the business, the performance, the robust performance demonstrated by the three divisions, which is clean energy and road and airport. And of course, airport is just launched, and last week they have started 24 hours operation. So the actual benefit will come in June quarter. But they are highly, the expectations are really skyrocketing because of the airports doing very well. And we are also expecting some kind of movement in coming quarters about the road projects, which will they kick in. So investors also gung-ho about the new projects. And the clean energy, the ANL division, which is the ANL, Adani New Industries Limited, manufacturing is also taking shape, and investors are pretty happy about that. But the one key concern, the pain point, is always coal trading, which they are concerned about. They are saying that the volatility will continue, the pain is going to persist, and Adani Enterprises will overcome that pain with the help of airport, clean energy, road, and other incubating businesses.
When it comes to Adani, there's a lot of interest in its fundraising, and we know it's been diversifying, and, you know, the local market has become increasingly important for the company.
Yeah, this is a great question. So, in fact, they're diversifying. Now, they're not, of course, they're looking at international markets also, but they're bolstering their footprints in domestic market. They've made successful NCD issues, and they had a successful rights issue, which will now be, capable of getting to the next phase of capex program. And, with the kind of projects which within the country, they are tapping the domestic market, and there'll be more smaller fundraising program tapping the domestic market is on annual. And investors and the lending communities are actually waiting for such kind of offering, and they're pretty happy about hugely, highly. They're thinking that this is going to help them to diversify from international market as the conglomerate is spreading their wings in the domestic market.
Sanjay, we're also keeping an eye on Adani's fraud case in the U.S. Any update on that?
Of course. So last Friday, the Council of Adani family representatives have agreed to take the summons from ACC, which is like a long-standing. It was actually a hindrance or a rather roadblock forever for a case which is filed in November 2024. And now there's some kind of clarity. Now between company and court, there's a lot more clarity, and there's 90 days to reply for the court's finding, and Adani family representatives have another 45 days to reply. Place the counter reply. So now it will take stream, and it will be a court to company proceedings rather than in limbo. This is actually with the trade deal happening. A lot of the external geopolitical overhang is also gone for Adani family and Adani Group per se.
So the course might be clear for Adani. Is that a fair assumption, given that the two sides, the US and India, Modi and Trump, are working it out?
Yeah, of course, there's no more geopolitical overhang for the conglomerate to power conglomerate, and funding route is also clear, and they are getting a better debt-to-equity ratio, and capex is in full stream for Adani Group.
Sanjay, thank you. Conglomerates reporter, PR Sanjay there. Now, more to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Asian markets retreating today following a tech-led sell-off in U.S. markets. The focus is on global software stocks as traders weigh growing risks of disruption in the sector after the rise of AI technology. Bitcoin, meantime, flashing a risk-off signal, touching its lowest level since President Trump's return to office a little more than a year ago. The crypto extended its almost 4-month slide, dipping well below the $75,000 level. And Indonesia's stock benchmark is showing signs of steadying after a massive sell-off sparked by MSCI warnings over its investability. Indonesia's finance minister says he's not concerned for now about the possibility of an MSCI downgrade to frontier market status. Speaking to us at a business forum in Jakarta, Purbaya Yudi Sadewa also told us why he thinks the index provider's warning is actually a good thing.
As I told you, the intransparency in the market was quite big. I've told myself to the stock market management at that, several months ago, to clarify the market from this cooking practice of manipulating prices of shares, but they didn't do anything. So to me, MSCI warning is a good thing, because I can write them to clear the market practice toward the better.
Are you concerned about a possible downgrade?
No, because it's improving the condition. Unless we ignore the MSCI warning until May, then we have to be concerned. But I think the government and every market regulators have taken a proper approach to ensure that before May this year, we will satisfy what the MSCI wanted. So you should be okay. You should be fine. Investing in my country should be okay. We will follow, adhere to the global best practices.
You're expressing confidence, but there is a real risk of being downgraded by the MSCI. Are you prepared for that? What measures are in place that could possibly mitigate the impact of a downgrade?
No, we will satisfy all of the MSCIs, all of things that MSCI wanted, including basic transparency. For me, as a Minister of Finance, I'm not involved in too much with what's happening in the boards, but I focus to ensure that the economy moving in the right direction. We make sure that our government spend enough money in the first quarter, second quarter in a timely manner, and we ensure also that there's enough liquidity in the market, and we are making sure that we are improving our business climate. We have this special task force of the bottlenecking, where every businessman can report to us, and on a weekly basis we have a meeting, a proceeding to ensure that the bottleneck that they are facing is removed properly. I think 1 year from now, we will have a different and much better business climate condition. That's enough to create a better and faster economic growth. Eventually, it will be represented on the increase on prices of shares in our capital market.
We recently saw the seizure of the Matabe gold mine, and some say that perhaps a reflection of the lack of due process in Indonesia.
Due process?
Due process.
Due process. Something like that has been occurring in our country over the last maybe 20 years or 30 years. We are improving, we are removing that bad practice in the mining industry. One of the samples is that the abolishment of the permit of the company. This is one step to make sure that we are conducting a good investment climate, a good practice in mining activities in the country. It's not like we are against mining, but we are against illegal mining.
There's a lot of speculation, and there's even suggestion from the likes of Citi, saying Citibank.
Economist from Citibank?
Yes.
He's not a real economist. He's only a master. You should ask a PhD to answer that question.
Suggesting that perhaps you will move your cap beyond 3%. Is there a chance of that happening?
I'm the minister, not him. I understand fiscal policy very, very, very well. I learned from the best from everybody in the world about fiscal policy. The reason why last year we pushed the deficit towards the boundary of 3%, because the economy has been slowing since the beginning of the year, maybe since 2024. Deliberately slowed down by our policymaker at that time, and the economy is moving downward. We have, if you learn the economy properly, in a downturn, the government should create a counter-cyclical policy to ensure that the downturn is not becoming a recession. We did that. We we expanded our fiscal. We give stimulus to the economy to make sure that the economy is returning like that, and it happened. In September, we managed to turn around the economic direction. September, October, November, until now. So we push the deficit towards the boundary, but at the same time, we managed to limit the deficit not surpass the 3% level. This is fun. We're so successful in creating a turnaround, but at the same time, we managed the 3% level. That's a work of an expert. I don't want to, in the future, I don't want to surpass the 3% level, because people like you, media, will crucify me and tell everybody that I don't know my job.
Indonesian Finance Minister Purbaya Yudi Sadewa speaking to us in Jakarta. Still ahead on Insight, Indian fintech firm MobiKwik turned profitable last quarter. We explore the drivers behind the turnaround with co-founder and CFO Upasana Taku. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. In the Indian market, it's not looking pretty for software companies the likes of Tata Consultancy, Infosys, HCL Technologies, and Wipro, all under pressure. Blame it on Anthropic. That's concerned the rollout of AI will decimate software companies and hurt profitability pretty much across the tech sector. Tata Consultancy down more than 5%. It was down as much as 6.2% earlier. Wipro down by about 4%. For more on the markets, let's bring in our Asia equities reporter Ashutosh Joshi in Mumbai. It's not looking pretty, but the question really is whether those losses will accelerate from here. What's the sense you're getting in the market?
Hi, it's been the top-seater we ride for Indian software stocks recently. While there in recent months we have seen some improvement in outlook for Indian software companies' performance going ahead, backed by some of the recovery seen in key client spending on technology. However, the latest news that has spooked the sector across is that with growing use of AI, a number of contracts that Indian as well as regional software companies benefit from, the spending might further be lowered and it could go towards AI or artificial automation. That can potentially be a heavy blow for Indian companies, especially which have shifted their models in recent years from being a back office operators to a software as a service company. Even though Indian companies have been spending and taking efforts to scale up their AI offerings or use of AI in their services, but still it needs to be looked in what way these companies can gear up and how quickly they can manage to tackle the challenges.
Are there any Indian software companies that are likely to do better than the others? Could it be a buying opportunity for some of these companies?
TCS, Infosys, as well as most of top Indian companies had a detailed conversations on their plans for expanding in AI or using artificial intelligence as a way to bring down their internal costs as well as automate some of the services they provide to their clients. However, one big change some of these companies are making is that they are deploying more and more of their workforce to be capable of using the AI. They are trained. TCS is training a number of its massive workforce to be ready to take up AI-related projects. That way, Indian companies are looking to scale their AI offerings. However, the challenge is pretty enormous, and only we will come to know as time passes what sort of measures Indian companies or levers they have to take on.
Ashutosh, India has always been seen as an anti-AI trade. Might we see contagion? Might it in fact hurt not just software companies in India, but India as a market as a whole?
India is seen. India as a broader market continues to be seen as anti-AI trade, simply because in listed space, India has very little exposure to the hot trade that global equity markets have witnessed in last year. That is closely linked to AI or establishment of the entire chain related to that. So that is the reason India as an equity market is seen as an anti-AI trade. But Indian IT companies or Indian software services providers are a vital part of the Nifty constituents. We have 5 companies which are a part of the Nifty, and even though in the recent past their stocks performance hasn't been great, they have been scaling up their offerings to make themselves more attractive in view of the AI trade.
Ashutosh, thank you so much for that. Our Asia equities reporter, Ashutosh Joshi in Mumbai. Now, Indian fintech firm MobiKwik shares are trading slightly lower after surging on Tuesday. The company reported that it swung back into profit, driven by reduction in payment processing charges and cost optimization. Indian fintech platform MobiKwik has reported that third quarter profit, marking what it calls a significant inflection point while continuing to scale its platform. The company provides services to millions of users. Let's get to their co-founder, executive director, and CFO, Upasana Taku. Upasana, good to have you with us. Congratulations on turning to profitability. I'm just wondering, how do you grow that at scale? What can be expected in the coming quarters?
Thank you and good morning, Haslinda. Thank you for having me on your show. I'm happy and very delighted to tell you that we had given a commitment in the last few quarters to our investors that we will be turning profitable in the second half of this year. And we have achieved not only EBITDA, but PAT profitability, tracking an EBITDA margin of 5% and a swing of about 576 million INR in EBITDA this quarter, year over year. But to your question on growth, I want to tell you that this has not been achieved on the back of cost saving. This performance has been achieved on the back of growth. So in our payments business, which is our core foundation, our GMV has hit an all-time high of INR 481 billion, which is marking a record high for the 12th consecutive quarter in a row. Our payments GMV has been tracking this kind of growth every quarter for the last 12 quarters. And this is on the back of 3.2x growth in our UPI transactions. I want to tell you that this quarter, as compared to same time last year, we are also in the top 5 fastest growing UPI apps in India. And these UPI users that we are acquiring at an explosive rate, they are also then utilizing other payment products and other financial services products on our app, and generating higher revenue for the company. On the other hand, the financial services business of the company, which was lagging for the last 3-4 quarters because of the consumer credit cycle in India, has finally given a very strong growth. We have reached a dispersal of INR 9,000 million, and this is surpassing all our previous peaks in personal loan distribution. I'm happy to tell you that in terms of the gross profit delivered by the financial services business, it's a 405% growth year on year. This is backed on amazing credit quality and collection performance. And this is why the company is...
Talk to us, Upasana, talk to us about what is realistic. What kind of growth is realistic? Because when I take a look at your numbers, it was 4 million rupee profit last quarter, revenue about 7%. Going forward, what kind of numbers can be anticipated?
No, absolutely. You're right. We have not been able to deliver extremely strong revenue growth this year. And it is our goal that now that we have reestablished profitability in our business, which was the first important milestone for us, and that's why we call it an inflection point. Now we know how we can responsibly grow both our businesses. We have strong momentum in payments. We have strong momentum in financial services. And we also have the new growth area of the merchant acquiring business in the payments side, where we are now basically sowing the seeds. And this will also deliver growth in the next financial year. So it is safe to say that, the company will be able to do much stronger revenue growth than current year in the next financial year. But we intend to do it in a sustainable and thoughtful manner. So scaling will be responsible and hopefully profitable.
Of course, there has been some headwinds. In fact, 400 million rupees in a fraud linked to a software glitch, as well as insider trading. How are you holding people accountable for this?
So the first thing I want to clarify, there has been no insider trading. So that is a wrong information. The company had reported that a technical bug in the system resulted in quite a few merchants from one district of Haryana in India to exploit and take unauthorized settlements from the company for the amount that you just mentioned. But I'm very happy to inform you that we also notified, as in our last results as well as this results, that almost 75 to 80% of the money has already been recovered back, and the balance is also in recovery process following the legal process in India. And that balance amount of about 110 was already provided for in our last quarter results. So we have already taken a hit for it, but we are very confident that we will recover the balance amount also.
I meant to say it is insider access and not insider trading. I stand corrected. In terms of senior level, officials, anyone will be held accountable for it?
Well, it wasn't really a failure on part of one human being. I would say that there were multiple process level failures, and we got a very reputed third party forensic risk advisory firm to give a report. And we found that we need to strengthen quite a few of our processes in the software development cycle, as well as in our merchant settlement processes. And we have taken all of those steps and provided those updates under the guidance of our regulator, RBI.
So you have taken concrete governance upgrades, and I suppose the public should be confident that this will not happen again?
Yeah, the public should be confident that this will not happen again. I would say that fraud keeps happening in digital platforms as well as so fintech firms like ours as well as banks. But the magnitude of this one was much higher as a contrast to our revenue. So yes, that kind of magnitude will not happen again. And we are taking the right steps in terms of improving our processes. We've also given an offer for somebody to join as the CRO of the company. So more governance and risk coming in. I think those were the processes that need to be upgraded in terms of the scale and the size of the company.
Some people point to the subsidies that you provide for transactions. Is this the way forward still?
Subsidy that we provide to the users, or the subsidy that the government provides on UPI transactions?
Subsidies that you provide to the users for transactions. Is that the way forward?
Actually,
and how are you looking at that?
No, actually, most of our growth is not on the back of user incentives of cashbacks. In fact, in our presentation for earnings, we've already reported that we've been bringing down very methodically and systematically the user incentives that we are giving. And despite bringing down the user incentives, we have been able to demonstrate fantastic, growth in our payments business.
Can you talk to us more about your lending products and how successful they have been and what the targets are for you?
So in terms of our lending products, currently the most important product for us is the personal loan product. And this product is provided to users of all, economic strata and earning potential in partnership with all the banks and NBFCs that we have on our platform. And the amounts could vary from 100,000 Indian rupees going up to 1 million Indian rupees. And these are typically 1 year to 3 year loans. In addition to this, we also do loan against mutual funds. We also have a RuPay credit card that we have launched recently. And we are also in the process of building new products such as merchant cash advance, which is a loan given to the small MSME merchants in India. So sizably, the current book is built on consumer credit, so personal loan dissemination, but we are trying hard to diversify in some of these products that I just mentioned.
And which businesses in particular are profitable at this stage, and what's the strategy going forward?
Haslinda, both the businesses are profitable. In fact, both the businesses have delivered, extremely strong in terms of the gross profit. The financial services business has given a gross margin of about 57%, and the payments business has given a gross margin of about 37%, which is why I was trying to tell you that the profitability that we have achieved is on the back of great execution and both businesses growing while delivering expanded margins. And now that we have achieved these expanded margins, we believe that they are stable and we'll keep growing with the same margins in place.
In our conversation with the government, they did suggest that the trade deal signed between India and the U.S. will help to boost growth even further. How might you capitalize on higher growth in India for the business?
So, ma'am, higher growth in India is directly, linked to the payment volumes in terms of the transactions done, whether it is, by individuals or the small businesses. And growth in GDP, growth in spending in the country directly helps, all payment processing companies, including MobiKwik as well as the banks.
Upasana, thank you so much for your time today. Upasana Taku, co-founder, executive director, and CFO at MobiKwik. Coming up, as Hong Kong's property market shows fresh signs of life, we get the outlook with JLL's APAC head of investor intelligence, Pamela Ambler. That's coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Hong Kong-based private credit fund Blue Mountain Bridge Capital Opportunities aims to double its lending into distressed assets in the city. This comes as a growing list of money managers positioned for further recovery after the deepest property slump in decades. Let's bring in Bloomberg Asia credit reporter Trista Sinyi-Luo. Trista, what's happening there?
Yeah, so investors are betting the property market is coming back. Meanwhile, there's still a lot of interesting opportunity to lend into some distressed asset. That's where they're eyeing for better returns. And we are seeing, as you mentioned about the the Hong Kong-based Asian private credit fund aiming to double its invested capital to $150 million by the end of this year. And last week, we also see, Blackstone was in advanced talk to become the biggest single largest shareholder of defaulted developer New World Development. So we definitely see more investors' interest in this market. And for the property market, we see some stabilization signs for the residential market. But we need to remember that for the commercial real estate market, it's still in deeply distress. Its value is actually slumped more than 50% compared to the value at the peak time.
So even though there are expectations that the market's bottoming out, there's still risks because there's still lots of uncertainty. Can they get the kind of returns that they're looking at, which is pretty much double-digit returns, right?
Yeah, so the fund we just talked about actually deliver double-digit return after fee to investor last year, and they're aiming to deliver the similar return to investor this year. So, and they're aiming for the secure lending opportunity on those distress and special situation opportunity in Hong Kong, and they are also in advanced talk with a lot of commercial banks in Hong Kong and try to buy their non-performing loan portfolio. As we can recall that the NPL ratio in Hong Kong has relatively high because a lot of the value of the collateral actually decline a lot, and for those banks they might eager to offload those back loans from their balance sheet. So those private credit funds are ready to go to eyeing for that kind of transaction.
When you take a look at office prices, they're down about 50%. I mean, you got to wonder where they go from here.
Yeah, exactly. Although we see some positive news about some, tech firms from the mainland actually buying office building in Hong Kong, but we need to remember that those buildings are mainly in, very premium location. For example, in Central or Causeway Bay, there are still a lot of office tower supply are in other regions, so they are, definitely hit hard.
Interesting. Trista, thank you. Bloomberg Asia credit reporter Trista Sini-Law. Meantime, consulting firm JLL says the Asia-Pacific real estate market is riding on positive momentum. It adds that economic growth across major markets, moderating inflation and lower interest rates will contribute to a more stable operating environment. Let's discuss this and more with Pamela Ambler, JLL's head of APAC's investor intelligence. It does feel like it is cautious optimism. There are risks still.
Definitely. And I suppose one of the first risks that we saw was yesterday, the announcement of RBA raising rates, which is a different trajectory. It's really the first mature market or an Asia market where we're seeing a reversal. We've talked about rates bottoming for this cycle, and certainly that's a big determining factor when it comes to deployment of capital and liquidity in the marketplace.
So as a result of people taking a step back, I mean, it was a surprise, right? I mean, RBA hiking rates and perhaps will hike again. That could be a reflection of what can be expected from other central banks.
Well, what's really great about the Australia market is the fact that the fundamentals are still very, very sound. So added to the rental growth that we see, Australia also has the demand side of the equation that is very solid. They have demographic growth. They have a young working population. And also on the supply side for Australia, in particular for offices, there is very little in the pipeline with very elevated costs of labor, cost of material. It's difficult to see new products in the pipeline. Added to the fact that they do have the Olympics coming soon, a lot of that construction activity is being tied up for infrastructure type projects.
You talked about how you're expecting the momentum from 25 to flow into 26. Can that be an acceleration? And can you take a look at Asia with a broad brush as opposed to differentiating the different markets?
Yeah, certainly. So we saw a very strong Q4 in 2025 leading up to 2026. And we have this, what we called a bid intensity index, which is looking at the forward indicator of liquidity. So it's momentum in the marketplace. We look at three things: the number of bids that are coming into each of the assets, the bid-ask spread. So the tighter the bid and ask, the more competition, and then the variability. And so all of the frustrated capital or the losing bids, if you will, they will likely look to bid for similar assets in similar regions. And therefore, we know for a fact, given what we've seen in the momentum that's building upwards, there is going to be more transaction activity. Also, when we look at 2025, we saw an increase overall of 12% uptick for APAC alone. And that is a continued momentum that we've seen since over the last 3 years. And we have now surpassed 2020 levels and also surpassed the longer term. And by longer term, I mean looking back at the global financial crisis period, pre-global financial crisis period up until now, we have surpassed that level in terms of transaction volumes.
Can you break it down in terms of sectors? I mean, what's looking interesting? I was quite surprised to see that perhaps the office space is quite a highlight now. Why is that? What's changed?
Well, for office for Asia Pacific, most of the workers didn't really return back to, or there wasn't the challenge of people not coming to work in the office. So that in itself has always been a lot more structurally sound for APAC markets. When we look at the allocations to offices in terms of the total commercial real estate universe, 44% roughly is allocated into office. Whereas if you look at that stats in the Americas, it's below 20%. So that dynamic is very different. Investors are now coming back into the office globally because of the pricing adjustment that have occurred for certain markets. And for APAC, again, it's except for Greater China, I would say most of the markets has a very balanced supply and demand side equation.
How about the other sectors, logistics, for instance, retail? What are you seeing in terms of those sectors?
The industrial and logistics space, we're certainly feeling a lot more bullish this year, given that last year's uncertainties around tariffs, supply chain recreation, that is beginning to dissipate. There's a lot more certainty. And with the demand on e-commerce, 3PLs, that continues to be the strongest end end users of logistics and warehouse facilities is very much still growing. We look at the CAGR in the pace of growth and demand. It certainly exceeds EMEA versus Americas. The other thing I would say about that sector is the fact that the recreation of the supply chain, the manufacturing that is needed still coming out of this part of the world is very much robust.
When we last spoke, I remember we talked about how AI is driving demand, and now increasingly we're talking about energy. Talk to us about how that's shaping demand and how that is playing out right now.
Yeah, certainly renewable energy specifically, when we talk about infrastructure, that is a context in which we are needing a renewable capacity to support all the data center demand. We look at the growing needs and of data centers, not just for hyperscalers, but for neoclouds, and to support various different growth for the digital economy that we're all moving into. On the infrastructure side, BESS, battery energy storage systems, is one of the technologies in which we're seeing the most amount of real estate or infra real assets type investors being interested in. And the reason being is because you can stabilize the electricity pricing a lot more when you have that energy stored ready for use.
So how do you best play that? I mean, in which markets in particular? Where do you see capital headed?
Yeah, well, we look at in terms of maturity and the availability of power. It's all about the power. And so where you can...
Would that be China?
Well, China does have a very strong, robust capacity, as well as India. But when we look at markets like Southeast Asia, there are certainly pockets of strength. We look at Japan, the cost for electricity is the highest. Building data centers, the cost is highest, and also the lead time is the longest. So depending on that dynamic, investors might want to look for those type of opportunities where there is a higher barrier of entry. And also on the private credit side of things, they're also looking to deploy private credit into data centers and infrastructure.
Private credit seems to be playing the market more and more. I've just had a conversation earlier about how capital in private credit is, very much focused on the AI and energy space. Can you give us a sense of the kind of growth in capital we're seeing from private credit in this space?
Yeah, well, private credit, I think initially everyone talked about Australia as the market where it's the most mature, where you're seeing it almost to a point where there is saturation. Hong Kong certainly is another market because there's been so much dislocation on the pricing front, the developers in need of capital injection. But now we're also looking at markets like Korea, where some of the domestic groups are looking and gaining exposure into private credit. And Korea, actually, keep in mind, that is the only market we're seeing in Asia Pacific where increasingly we're seeing more cross-border capital investing into that market compared to the pre-COVID period.
And Singapore has been a focus when it comes to property. In fact, there's a new kid in town. There's a new property fund in town. And in fact, it is founded by QIA and APG, and it's worth about, $6 billion in terms of AUM. What's your take on that? I mean, this must be a reflection of the opportunities out there.
Yeah, absolutely. So the timing actually is quite well-timed, given Singapore's SORA rates have come down significantly. So now we're looking at roughly a 2 basis points difference from cost of borrowing compared to Japan, where everybody in the past had pegged Japan being the lowest cost of debt. So the office market is certainly seeing a resurgence of foreign and domestic capital coming in. We have a very robust pipeline. Singapore has always been that safe haven market where capital likes to go, likes to deploy. The challenge for Singapore in the past is a couple of things. One is the assets are all very, very large, comparatively speaking. So those opportunities are larger for those selective type buyers, or the fact that there wasn't a whole lot of, we didn't see discounts for assets transacting in Singapore because the market fundamentals have been so sound, and that was preventing some of the investors from wanting to come into the market because they'd rather find a bargain elsewhere. Now, that has changed as we move into 2026. From the second half of last year, we did see rates come down quite significantly for the cost of debt. And being the sound safe haven market, highly transparent. We're certainly going to see a lot of activity in this space.
How do you see this fund unlocking value best?
Well, we last year and continuously this year, we also have seen a lot of REIT listings, securitization of various different asset types, including data centers. We also have various different types of worker living formats being securitized. That could be one. So that activity being available on the market where you see capital coming in, there's no shortage of product, that makes for a very good match.
What themes are you looking at for 2026? I mean, we talked about how, there's divergence in terms of monetary policy, there's uncertainty in terms of geopolitics. How is it shaping the industry and shaping the way capital is deployed?
Well, Japan continues to probably take the pole position in terms of investor interest, despite the fact that rates are going to be moving higher and bond yields have been quite volatile at the start of this year.
It's taken a long time.
That's right. And they're certainly determined to stamp out deflation once and for all. So despite the fact that inflation has been well over 2% for now almost 4 years, that's actually a very healthy signal for the economy and for the commercial real estate business, because you can ask for higher rents, where reversion rental growth, that was not something that existed before. And if you look at the what's happening in Japan, there are a lot of activist investors that are going into that market, picking up assets that are undervalued, that sit on corporate balance sheets. That's also unlocking product and unlocking opportunities.
But a lot of funds are looking at Japan. It's become a competitive space, and you'd imagine that's actually driving valuations higher.
We're certainly getting that question. Are we in a late cycle? Is it getting too frothy? But the fact that the investable universe for not just Tokyo. If I give you an example, Tokyo alone is larger than Sydney, Seoul, and Sydney combined. That's just telling you how big it is. And investors are not just limited to Tokyo anymore. Osaka is a very big market. You have TSMC building out plants, and that's in further areas. Fukuoka, Nagoya, those are all attracting foreign investor interest. So that product universe is just ever expanding.
Pamela, great perspective. Thank you for dropping by. Pamela Ambler of JLL. And oil gaining today as the U.S. shoots down an Iranian drone in the Arabian Sea. But President Trump says diplomatic discussions with Tehran are continuing. An update on those tensions next. Keep it here with us. This is Bloomberg.
They are negotiating. They'd like to do something, and we'll see if something is going to be done. They had a chance to do something a while ago, and it didn't work out, and we did Midnight Hammer. I don't think they want that happening again, but they would like to negotiate. We are negotiating with them right now, yes.
President Trump confirming talks with Iran are ongoing after the U.S. Navy shot down an Iranian drone in the Arabian Sea. For the latest, let's go to Dubai and bring in Horizon's Middle East and Africa anchor, Jumana Basachi. Jumana, put this in perspective for us. We heard from President Trump saying they'd like to do something, but there's a lack of clarity what that something is.
Yeah, well, it appears to be the case that diplomacy is certainly the most favored course of action, at least for now, Haslinda. And I think there was perhaps a moment last night when it looked as though things were really getting heated once again. Several provocations. We had at one point in the afternoon news that Iranian vessels had actually approached a U.S. oil tanker on the Strait of Hormuz. So that was the first provocation. Shortly afterwards, U.S. CENTCOM announced that they had actually shot down an Iranian drone that had approached the aircraft carrier, the USS Abraham Lincoln. So on the back of that, you saw the spike in oil prices. They jumped about $2.50 on the news on anticipation that perhaps this could lead to something more substantial from a military perspective. But it wasn't that long afterwards that we heard from President Trump and from the U.S. Press Secretary Caroline Leavitt saying that the plan is for the negotiations to still continue this weekend. So these these are negotiations between U.S. and Iran. And so the question is, where exactly are they going to be held at this point? There were reports that Turkey were looking to host the talks this weekend, but then some other reports came out overnight suggesting that Iran's preference would be for the talks to be held in Oman. Remember, last year when those negotiations were taking place prior to the June war, they also took place in Oman as well. And then a question about who will be present. Caroline Levitt saying that Steve Witkoff plans to attend the talks, in addition to the Iranian Foreign Minister Abbas Araghchi as well. The Iranian President Masoud Pezeshkian saying that he had directed the foreign minister to engage in those negotiations in a, quote, equitable manner. So we'll see what comes out of those discussions. But ultimately, it is a question of how different this round of talks is going to be from where we were exactly or a little over a year ago in the run-up to the June war last year. And the U.S. are pushing for including more subjects in this round of negotiations, not just keeping it exclusive to the nuclear file, but also to Iran's considerable stockpile of ballistic weapons, in addition to the fact that they continue to fund proxies around the region. Iran seemed to be pushing for just a discussion around their nuclear ambitions and their nuclear weapons stockpiles. So again, early days, it does seem like the window for diplomacy is still open, but whether it yields anything different from what we got a year ago is the big question mark for this region and I would say for the world as well.
And that's right. Diplomacy is preferable right now, but it takes two to tango. You got to wonder how much or how far Iran is willing to go. And for the U.S., Jumana, it is pretty clear all options are on the table still, including military force.
Yes. Yeah, absolutely. And Haslinda, you don't need to look very far beyond the huge buildup of military assets in the region as well. And this time around, there has been a substantial buildup in terms of not just that carrier that I was talking about, but additional jets that have been sent to the region, F-35s, F-15s, buildup of troops as well, all of the language that's coming out of the Trump administration. And there certainly seems to be a strong contingency within the Trump administration that would like them to pursue military action. So again, coming back to what we were saying and the element of trust here between the two sides and whether actually both parties are negotiating in good faith or whether it's just a stalling tactic or buying tactic, U.S. want to extract the utmost concessions from the Iranian regime, but at the same time, they are building up a massive military presence around the region, and therefore this could be a precursor to more kinetic military action. But then again, the question becomes, what is the plan for afterwards, and whether if the U.S. go down the route of conducting a limited strike or a military strike, whether that would actually yield any difference on the ground and whether it could create a fissure between the IRGC and the supreme leader, whether Khamenei will actually be replaced. I mean, these are big picture questions, and certainly there are a lot of people wondering whether it would be right at this point for the U.S. to go down that route without a full plan in place.
Jumana Basachi, Bloomberg Horizons Middle East and Africa anchor, thank you so much for that. Meantime, oil, as Jumana said, is trading higher in Asia as those geopolitical tensions resurface over Iran. The American Petroleum Institute, meanwhile, says U.S. crude inventories fell by 11 million barrels last week. Let's bring in Stephen Stepczynski, who leads our Asia energy coverage. Okay, I'm not understanding why oil prices are higher when there's ample surplus in the market.
Yeah, I mean, we are entering a market that is frothier than it was in years in the past. But I think, let's take a zoom out. Let's look at prices, right? So Brent is in the mid to high 60 level per barrel, dollars per barrel. If this were 3 or 4 years ago, we would be seeing Brent higher, closer to $100. So let's remember that we are much further down, but there are a lot of risk premiums that the market is kind of bidding into it, right? So clearly, Iran is a fear in the market. Iran, while they are sanctioned, their oil is sanctioned, it does find their way into the market. They export, they produce, and if there is an attack, if there is some sort of military strike on Iran, and it does affect output to some degree, you will see an immediate reaction because that does tighten slightly the amount of supply. We're not going to see shortages, but it does cause less oil to get into the market. So that would be a bullish reaction. I think the worst case scenario is clearly the Strait of Hormuz, right? If there is harassment of vessels going through the Strait of Hormuz, that's a key conduit for not just oil, but also natural gas. And then you would see a larger increase in prices. We saw something similar happen last year around June or July when there was more tension. So I think that's what the market's looking at, not so much the supply demand. They're pricing in these risks.
All right, Stephen, we have to leave it there for the moment. That was Bloomberg's Stephen Sapczynski, who leads our Asia energy coverage. And before we go, here's a look at our show tomorrow. TenCap founder Junbei Liu joins us with Market Insights, and we'll have the exclusive interview with the CEO of Tata Power after their third quarter results out later today. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.